Hello friends. Today we'll see an overview of what is accounting. Before we start the class, I would like to introduce myself as Srinivas Banerjee, having an experience of more than 3 decades in banking and IT industries. Recently, I have started a new YouTube channel called Sadhana Channel to cater to the needs of various sections of student community as well as the IT teams. Let us understand what is accounting. So, accounting is a systematic recording of transactions. We'll also see what is systematic recording and what is a transaction and how do we differentiate a transaction from an event. So, if we have to define accounting properly, it is systematic recording of information, classifying the information, and summarizing the information. But can we record all the information that is available in the accounting records? Not necessarily. So those transactions and events that can be measured in terms of monetary terms only are to be recorded in the accounting records. Then accounting is more than recording of information. It is also to interpret the information. We'll also understand what is interpretation of information. So now we have understood accounting is recording of transactions or recording of information and also interpreting the information. Let us understand now what is a transaction and what is an event. See, any activity we can classify into a transaction or an event as far as the accounting is concerned. Suppose we perform an act, we invest some money in the business, we purchase goods, we sell goods, we generate income, we receive some cash, we spend money, there will be some expenses. So there will be multiple activities in a business. And if it is a manufacturing organization, there is also a procurement of raw material, transportation of goods into the factory, purchasing a plant or a machinery, installation, and so many additional activities also will be there if it is a manufacturing concern. Before we discuss deeply the meaning and the important concepts of accounting, I would like to emphasize that whatever discussion that we are doing today is confined to the business only. Because accounting is not just limited to a business. In fact, we can also record all the transactions that happen even in the families. But our discussion as far as accounting is concerned and the related concepts, it is restricted to the world of business. Okay. In that context, now we have understood that transactions are nothing but the activities relating to performance of an act. We have already seen the examples. We'll also discuss the transactions and events with respect to a particular example. Then coming to events, they are the result of an act. Means they are the consequence or the occurrence or the outcome of all our actions or transactions. So means they are not direct. So what is direct here is transactions and what is indirect is here is event. Let us see with the help of an example. Suppose there is a kirana shop. So the Kirana shop owner has started the business with some initial investment. He has purchased some provisions to start the business. Then he has started selling those provisions. He has to pay rent to the premises, that is for the shop, electricity, and he has to hire an assistant to help him in the day-to-day business. So for him, he has to pay some salary. So these are all the activities that a Kirana shop normally does. Let us see what are the transactions and events in this case. So whatever he has invested as part of his capital and whatever purchases, sales, receipts and payments he does as part of business, they're all actions done by him. So hence they are called as transactions. Then what are events? As we already discussed, they are not direct. They are only the outcome of various activities that a businessman performs. So in this case of Kirana shop, when he has purchased some goods and he has sold some part of his goods, he is left with some stock on hand. That stock on hand is an event because he is not doing anything directly to hold some stock. He is buying and selling the goods, and at the end of the month, when he draws a balance sheet or a financial statement, he is left with some stock that is normally called as stock on hand. That stock on hand is the result of his activities of one particular month. So that stock on hand is an event. Similarly, when he is doing a business, for example, for a particular month, he ends up in some profit or loss. Then the profit or loss also is an outcome of the activities done by him. So that is also an event. It is not a transaction. So whatever he is doing for exchange of goods, services, or funds, they are called as transactions. And whatever are the outcome or the results or the consequences of those activities, they are called as events. Then, coming to the basic definition and the scope of accounting. Accounting is systematic recording of transactions. That is what we have been discussing so far. So what is meant by systematic recording, we'll see when we discuss the accounting concepts during the current session. So recording of transactions, normally they are done with the help of bookkeeping. All the transactions are first entered into a book called journal through journal entries. And then from journal, all the transactions are posted to different ledgers. And once ledgers are completed, then we generate a trial balance. Okay. Trial balance is nothing but a summary of all the ledgers. Then after this, the next stage is to prepare a trading and profit and loss account. These two accounts will show the performance of the business. And finally, we will generate a statement called balance sheet, which is also called as the statement of affairs, which will indicate the financial position as on a particular date. So we have recorded all the transactions and events. We have already discussed what is a transaction, what is an event, and we have posted them into a journal, then posted them into ledgers, generated trial balance, prepared trading and profit and loss accounts, and finally prepared or drawn up a balance sheet. Then after this is all called as generating of financial information. Then once the information is generated completely, then we have to communicate this information to users of financial statements. We'll see who are the users. There are two types of users, internal and external, for the accounting. So when it comes to internal, all the owners, senior management, partners, employees. They are all the internal users of the information generated by the accounting records. Then external users are those customers or those parties who are customers, means customers of our business. Investors means who have invested their money in our business. Lenders means who have lent their money, means from whom we have borrowed money for the purpose of our business. Suppliers for raw materials or for, in the case of Kirana shop, for provisions or whatever it is. Creditors, if we are buying the goods on credit, creditors are also users. Then government as a regulator, and public who will be trying to understand what kind of contribution a particular business is making to the whole economy. So these are all the different types of users or sets of users who are interested in the information generated by the accounting records. So there are transactions and events which are recorded in the accounting records, and the same information is used by this set of different users. Then there is a slight difference between bookkeeping and accounting, because normally people tend to understand both bookkeeping and accounting as one and the same. Well, it is not so. So bookkeeping ends only with the recording of transactions. Means it ends with, say, it starts with journal entries and ends with the preparation of ledgers. Whereas accounting is slightly beyond the bookkeeping. Accounting includes summarizing of information. As we discussed, summarizing of information is done through trial balance, to trading account, P&L account, that is profit and loss account, and balance sheet. So whereas that is not part of bookkeeping. So bookkeeping will have only journal entries and ledgers. Whereas accounting includes the summarizing of the financial statements. Then preparation of financial statements like balance sheet, as we discussed. And they're used for decision making, as we just discussed, because there are different users that need the information to make so many decisions about the business. And accounting has some important subfields like financial accounting, cost accounting, management accounting. We'll see what are they in brief. Whereas bookkeeping will not have any subfields. So as far as bookkeeping and accounting are concerned, bookkeeping is part of accounting. Bookkeeping deals with journals and ledgers, whereas accounting is beyond journals and ledgers. Then there are some limitations to the accounting records. Because as we discussed in the initial slides, transactions and events are recorded which are measured in monetary terms are only stored in the accounting records. So that is a limitation. For example, we all know that human capital is the most valuable asset in any organization or for any organization. Are we recording the human capital anywhere in the balance sheet in the name of accounting? No, not so far at least. Why? Because we cannot measure the human value, okay, their skill, their talent, or their expertise in terms of money, and we cannot convert that into monetary terms, and we are not recording the value of such an important asset in the books of accounts. So that is a limitation. Then financial position on a given date. It means that whenever we generate a balance sheet, it reflects only the financial position, whether it is solvency or liquidity position of a particular business on a particular date. Means it always talks about the position for a given date. Suppose today we are in 2020 and we are trying to read a balance sheet of a particular company pertaining to 2018 or 19. So means the statement of affairs or the financial position or the balance sheet that we are trying to analyze is not of current date. It will not reflect anything as on the current date. It is reflecting the position on a given past date. So that is a limitation. Similarly, there are multiple accounting policies and principles that we'll see in the next classes, based on which the accounting records are prepared. So when it comes to multiple accountants or multiple types of entities, people tend to choose different types of policies and principles so that the information generated by them cannot be compared with one another. That is also a limitation. And similarly, in the accounting, there is a lot of subjectivity because we have to make provisions in the accounts. For example, in every business, there is always a possibility of some amount going bad. Means whenever we are selling goods on credit, some amount we cannot recover from the debtors. Means from the customers to whom we have sold the goods on credit. For that, we have to estimate some amount and make a provision in the books of accounts so that it conveys a proper reflection of our status to the users of the accounting records. So we have always to remember that the accounting is nothing but generating of information and utilizing the information by various users. So we have to keep the users always in mind and try to make the best estimates and make use of the best practices and policies and principles and adopt them to reflect true and fair view of the financial performance and financial status of the business to the users. So in that context, when it comes to 100 say accountants of 100 companies, there is a possibility that all 100 people choosing different types of or make different types of judgments in making provisions or valuations of their own inventory or assets and liabilities using multiple methods or different methods before they record the transactions and events into the books of accounts. That subjectivity is also a major limitation of accounting. So as we discussed earlier, there are many subfields for accounting. We'll see some of them. Financial accounting is nothing but the regular accounting, that is preparation and interpretation of financial statements that we have been discussing so far. So means preparing trial balance, trading account, profit and loss account, balance sheet, and even cash flow statements. So this financial accounting is meant for the outsiders, because when we discussed the users, we have discussed about the internal users as well as external users. This financial accounting is meant for external users. Management accounting. Management accounting is meant for internal use, means for owners, management, senior management, partners, employees, and so on. And there is also a subfield of accounting called cost accounting, which is very, very important for manufacturing concerns, where the focus is on measurement of costs and controlling of costs. So they record each and every aspect of cost to arrive at the unit cost and then add some margin to arrive at the price. So measurement of cost and controlling of cost is part of cost accounting, which is also a major subfield of accounting. So there are different types of accounting that we need to understand. Then there is also a relationship of accounting with other disciplines. Means it cannot survive alone. It has to depend on various other disciplines. For example, laws. Because whenever we deal with companies are regulated by the Companies Act. When it comes to trading of goods, there is a law called Sale of Goods Act. When we enter into agreements, there is a Contract Act. So accounting is subject to all these mercantile laws. So whenever we are recording the transactions, whenever we are interpreting the information generated by the accounting records, we have to keep all these laws in mind. Similarly, taxation. So there is a direct tax, there is a GST that is called as indirect tax. There are customs duties and all. So whenever we are doing, say, a business, when we earn income, we have to pay tax on our business. And similarly, whenever we are buying goods or selling goods, we have to take care of the GST. And similarly, whenever we are importing or exporting, we have to take care of the customs, excise, and other duties that are applicable for the business. So similarly, economics, when it comes to decision making, so there is an overlapping, say, concept of decision making between accounting and economics. Statistics, there is a lot of approximation that we do in accounting when it comes to interpretation, analysis of financial information. So there we use statistics. Though we record the last paisa of the transaction in the accounting records, when it comes to interpretation, we use statistics for approximations. Similarly, mathematics. All accounting is based on dual aspect of accounting. We'll see what is dual aspect of accounting. So that dual aspect of accounting is related with algebra and mathematics. Similarly, management. Accounting is also related to the management, because what is that we are doing in accounting? We are doing a systematic record of all the transactions and the events. Means we are doing a lot of planning, we are doing controlling, we are doing organizing. So many management functions are already done by the accounting, whether directly or indirectly, as part of accounting function. So that is how it is related to management. Now we will see some important concepts. So this is a very important part of this particular session. We'll try to understand different concepts based on which the recording of information is done in the books of accounts. Before we start understanding different concepts, there are various terms that we use in accounting. Somebody says accounting concepts. Somebody uses the term accounting principles, accounting practices, accounting conventions. So all of them, they almost mean the same thing with a slight difference which we need not understand at this stage. So whether it is concept or principle or practice or convention, at least at this stage, it is all one and the same. So with that assumption, let us try to understand some of the important concepts as to be kept in mind when we record the transactions. So this is nothing but a systematic recording of transactions. Then entity concept. So in the entity concept, what it says is business is different from the owner. Suppose in the same example of a kirana shop, he is doing a business of kirana, and one day he draws some money from the shop for his personal consumption, or takes some goods for his consumption, personal consumption. So what entity concept says here is it should not be part of the business. Means the business and owner are different, and accordingly the drawings made by the owner, whether it is in the form of cash or in the form of goods, is to be accounted for properly. For example, the kirana shop owner has started his business with 1 lakh. Then okay, he has purchased some goods, he has sold, he has made some profit, paid some amounts, received some collections, and at the end of the month he has made a profit, and that profit we call it as an event, and whereas all the transactions done by him are the transactions, because there is an exchange of goods or services or funds. Okay, the outcome of the business is the profit. Okay, that is an event, and the outcome of the transactions is some inventory at the end of the month. That is also an event. Okay, then suppose when he has drawn 5,000 rupees cash from the business, then whatever he has initially invested, that is 1 lakh rupees minus 5,000 will be his net capital in the business, that is 95,000. So that 5,000 rupees we have to treat it as drawings and reduce that 5,000 rupees from the capital and to reflect only 95,000 as his investment and not 1 lakh. So that is what entity concept is saying. So we have to treat the business and the owner or owners differently. Then money measurement concept. We have already discussed this concept indirectly. So what this concept says is when we are recording the transactions, we have to record only the transactions and the events that are of financial character. Means that can be measured in the terms of money. As we discussed, human capital, we cannot say account for it. So we cannot record it, though it has some value in it. Then periodicity concept. This is a very important concept because all the accounts are prepared for a definite particular period, whether it is 1 year or 15 months. Mostly it is 1 year in most of the cases. Only in some cases, or when we start the business, say in the middle of the financial year, the first set of financial statements are prepared for 15 months, and later on it is only for 1 year. So that is what we have to follow when we are recording the transactions. So far we have seen three important concepts: entity, where the owner and the business, they are different, and money measurement, only the monetary items only are to be considered in the books of accounts, and periodicity, all the statements of accounts are to be prepared for a particular year so that they are comparable. Suppose 2018 and 19, if I am comparing different statements, trading account or profit and loss account or balance sheet, so they should belong to say a 12-month period only. So one statement cannot be prepared for 6 months, another statement for 9 months, and third statement for 12 months, and so that they become uncomparable. So that is not the concept. These are the fundamental concepts which have to be kept by the accountants when they record all the transactions. Then only it is called as systematic recording, and then only the information generated by such accounting records can be interpreted or used properly by different users, as we discussed earlier. Then accrual concept. So in any business, there are two types of transactions: cash transactions and credit transactions. So what the accrual concept is saying here is all the transactions are to be recorded as and when they occur. Means irrespective of whether you receive cash or you pay cash, they are to be recorded as long as they belong to a particular period. So for that, there is a small equation coming out of this accrual concept. Revenue minus expense is equal to profit. Suppose I have purchased goods before I sell them. I have purchased goods worth 50,000 rupees, out of which I have paid cash for 30,000 only, and 20,000 rupees I have purchased on credit. So when I record this transaction of 50,000 purchases, I should not restrict my entry only to 30,000 just because I have paid cash only for 30,000 rupees and the rest of the goods are bought on credit. No. So entire 50,000 rupees is to be recorded as a purchase, irrespective of whether it is on cash basis or on credit basis, when it is belonging to the same period. Similarly, sales also, I do credit sales, I do cash sales. So if I had to receive some money, that also, if it is belonging to the current accounting period, I have to record that transaction. So that is called as accrual concept. So transactions during a particular period, as and when they occur, they are to be recorded. So entire revenue is recorded like that only, and entire expenses are recorded for a particular period, whether we receive them, means whether we receive in cash or not, and the balance is equal to profit. Then matching concept. All expenses matched with the revenue of a period only are considered. So whenever I buy goods or whenever I sell goods as a sole proprietor in the same example of a kirana shop, I have to match all my expenses with the revenue first. So the matched expenses versus gross revenue. That principle we have to follow when we are recording the transactions. Going concern concept. So this is very, very important. Going concern concept. Suppose when we are preparing a balance sheet, we have already prepared a balance sheet in 2018. Then on 2019, when we are preparing a balance sheet, there is a change in the value of assets and liabilities without our, say, intervention, because market has gone up or market has gone down. And my machinery is costing, earlier it was costing, say, 10 lakhs in 2018. And whereas in 2019, it was costing 12 lakhs or 8 lakhs. So the 10 lakhs worth of machinery, the value has changed either to 12 lakhs or to 8 lakhs in 2019. It will not be recorded because all the accounts are prepared on a going concern concept. Means the entity will continue to exist for a definite foreseeable future. We are not closing down the business in the near future. Operations will continue. So that is the major assumption based on which we are preparing the accounting records. So we need not revalue our assets and liabilities just because or as if we are closing down our business. That will be done normally only in the liquidation of business. So in the going concept, so when we are preparing the accounting records, we have to treat the concern as a going concern concern and accordingly record the transactions on a historical cost basis. So that is the concept of going concern. Then cost concept. Cost concept is also similar to a going concern, where we consider only the acquisition cost when we record all the assets. Then realization concept. This is another concept. So here the recording of transactions will be done only when it is realized. Suppose there is a gain that is likely to occur in our business. We are sure that the prices are going up or the prices have gone up, but we have not yet sold them at the revised prices. Do we record them at the revised prices? No. Only when we do sales at the revised prices, then only we record them at the revised prices, because we have realized that price, we have realized that profit based on the revised prices. So till such time, we cannot record them unless we realize the profits or gains. So that is about the realization concept. Dual aspect. So this is the core concept of the entire accounting, where every transaction has two aspects. We normally call them as debit and credit. We'll see in the double entry system. So with this, we are coming out with, so far we know that there is a balance sheet. Balance sheet will have assets and liabilities. When we say liabilities, it also includes the owner's equity. So the equation that we can generate from the dual aspect of say accounting concept is that equity plus liabilities is equal to assets. So this is a very important concept that we have to keep in mind when we are recording the transactions. What is that we do in the name of dual aspect while recording the transactions is, so every increase in asset will have either decrease in asset or increase in liability. So this is a relationship between assets and liabilities only. Means assets and liabilities and of course capital. Because on one side we have assets, on the other side we have equity and liabilities. So the equation is always between the set of equity and liabilities on one side and the entire assets on the asset side. So when we are recording the transactions, we have to follow the dual aspect. Then conservatism. So as a conservative accountant, we record all possible losses that are possible losses means they're likely to happen, and ignore all uncertain gains, in the sense that if the gains are not certain, means if they are future and if they are not certain, we will not record them. And the principle followed for this is conservatism. So conservatism concept is nothing but recording all possible losses, means we are booking all the losses upfront and ignoring all the uncertain profits as of now. Then consistency. This is also a very important concept. When different accounting policies, practices are in place, as we discussed earlier, for example, depreciation methods. So there are multiple methods for handling the depreciation. There is a method called straight line method. There is a written down value method. There is an annuity method. And similarly, when it comes to the valuation of goodwill, there are, say, many methods. Similarly, when it comes to valuation of inventories, there are some methods. When it comes to the estimation of, say, useful life of the fixed assets, there are certain principles or practices. So, when different accounting policies are possible for a similar item, then we need to adopt a consistent principle right from the beginning till the end, so that the information generated by the accounting records is comparable and uniform. For example, if we use the straight line method of depreciation in 1 year and change the method of depreciation from straight line method to written down value method in the next year, then the financial information is not comparable. Then users are affected. They cannot take or make proper decisions with respect to their investment or interest in the business. So we always to keep in mind the users' perspective. Whatever information that is relevant, whatever information that is required by them for the purpose of decision making, we need to keep that in mind when we are preparing the accounting reports. Even the whole set of concepts are emanated from that single point of agenda, that is user's point of view or user's perspective. And similarly, there is one more concept called as materiality. So materiality, it is like a dictionary meaning only. Any significant item that is having some economic effect on the business only will be considered as part of recording. So irrelevant items or immaterial items will not be brought into the books of accounts. So using, say, various concepts, we have to prepare the accounting records. That is how it is called as systematic recording of information. Then, before we conclude, we'll also try to understand the fundamental accounting assumptions. There are 3 fundamental accounting assumptions that every accountant has to keep in mind to follow, and they are going concern concept assumption, accrual assumption, and consistency. In fact, we already discussed all these 3 in the name of different concepts. Going concern is nothing but the operations will continue for, say, some more years. With that mind only, he has to prepare all his records, means accounting records. And accrual, as and when the transactions take place for a particular period, so he has to record all the transactions. It is not just as and when he receives cash for the transactions, no. So we have to take a particular accounting period, and whatever is belonging to that particular period, whether the cash is received or not, everything is to be accounted for on due basis or on accrual basis, irrespective of the actual receipts or payments of cash. Then consistency, as we just now discussed. So when we are following different methods or principles or concepts to record the transactions, We have to use them consistently from the beginning to the end. And whenever there is a change that is required by the law or statute, then we have to properly give some disclosures in the accounting statements, and also to mention the impact of such change on the financial information, so that users can understand the change in the accounting policies and their impact properly, so that they can make relevant decisions on the financial information. So coming to the summary, so these are all the points we have discussed today. Systematic recording of transactions and events, nothing but say using the standard concepts and accounting assumptions, recording all the transactions into a journal, and then classifying nothing but grouping of all the journals into ledgers, summarizing the information. Summarizing is nothing but preparing the trial balance, trading account, profit and loss account, balance sheet, cash flow statements, and all. Analyzing the information, this is for the users. So we have to analyze the information because we have to classify various assets into a particular group: tangible assets and intangible assets, current assets and non-current assets, similarly current liabilities and non-current liabilities, and similarly when it comes to shareholders funds, equities and reserves. So this is all called as analyzing. So the whole purpose of accounting, as we have been discussing right from the starting of the class, is to generate information from the accounting records, and also to utilize that information by the users for their decision making. So analyzing is part of utilization of information, whereas recording, classifying and summarizing of information, they are related to generating of information. So continuing the utilization of information, it is also interpreting. Interpreting means, so with the help of various ratios, we can interpret the financial performance and financial statements. Similarly, communicating to users is the most important aspect of accounting. It is not generation of information and utilization of information by the internal management or the owners of the business. It is to communicate the information, means the financial information, to the external stakeholders who are interested in the business. So they are all government, public, customers, lenders, suppliers, investors, and so on and so forth. Then we also understood some subfields of accounting, like financial accounting, management accounting, cost accounting. There are certain limitations, of course, because there is a lot of subjectivity still involved in the preparation of financial accounts. So there are some limitations, because whatever we can say measure in terms of monetary items, only we can record them. So on and so forth. The accounting has some relationship with other disciplines, particularly legal, taxation, then mathematics, statistics, management, and so on. We have seen different concepts: entity concept, for measuring or for measurement or classification or presentation or recording of information. We have discussed so many important, say, principles or practices or concepts in the name of entity concept, measurement concept, going concern concept, accrual concept, periodicity, materiality. So all these are very, very important when it comes to systematic recording of transactions. And finally, we have also seen the fundamental assumptions based on which the entire financial information is generated and interpreted by the users. There are three. That is, going concern, means the firm will continue or the business will continue to operate for some more years. That is number one. Number two is accrual. So as and when the transactions take place, they are recorded in the books of accounts. It has nothing to do with the actual cash payments or receipts. And the third and most important accounting assumption is consistency. All the accounting principles, practices, or concepts that are adopted by a particular business are continued from the beginning to the end, unless there is a statutory regulation to change the methods or practices or principles. So with this understanding, I will conclude my first session on the accounting overview, and I'll continue the sessions with the newer aspects of accounting like journal entries, trial balance, trading account, profit and loss account, balance sheet, bank reconciliation statement, rectification of errors, and so on and so forth. So finally, what we have to understand, say, accounting as is, it is a language of business. Means the business language is accounting. Taxation, audits, advisory, and legislation, they are tightly coupled with the accounting practices and principles. So one need to understand, means the accountant who is preparing the records has to keep in mind all these legislation and say guidelines when he is preparing the books of accounts. And finally, accounting has become a learned profession nowadays. We have so many chartered accountants, we have so many cost accountants, and still there is a lot of requirement for this set of accountants who are part of Elite Society as of now. So if you like the video, please subscribe to Sadhana channel, and your valuable feedback, suggestions, comments, they're welcome on my email. That is nothing but rushiforca@gmail.com. Thank you very much. Thanks a lot.